Welcome back. Several interesting restaurant and retail calls to get through today. And for that, Rahel Solomon joins us with the details. Hey there, Rahel.
Very interesting indeed. Hi, Scott. So analysts at Baird are looking beyond the short term and upgrading Darden restaurants and Texas Roadhouse to outperform from neutral. They call the two best-in-class operators that will benefit from reduced competition. Both stocks have had huge runs since their lows, up around 300% and 200% respectively. Scott, Matt Boss at JP Morgan upgrading Gap to overweight. Price target here goes to $30 from $22 a share. So this is on strength at Old Navy and Athleta, and that's even despite the potential Gap catalyst with that Kanye partnership in 2021. This stock is jumping today, up last I checked, 8.3% there, and now up nearly 50% this year. That same note, Scott, sees American Eagle Outfitters getting an overweight, citing strength in the Aerie brand. Price target there goes to $22. And sticking with retail, Foot Locker gets downgraded to underweight at Piper Sandler. Price target is bumped up $4 to $29. Now, this is largely on Nike's growing strength in direct-to-consumer. 71%, Scott, of Foot Locker sales are Nike. And consider this, Nike's digital business is now on pace to eclipse Foot Locker's expected revenue. This stock is up 120% from its 52-week low and 40% in just the past 3 months, Scott.
Oh, interesting. Rahel, thank you. Rahel Solomon there. So, Joe, I'm going to start where Rahel ended. So Foot Locker used to be a good play because of the exposure that the company had with Nike. Now, as Rahel just told you, the amazing growth that Nike's had in its own digital sales makes Foot Locker an underweight over at Piper Sandler, and you own Nike.
Well, I'm staying with Nike. I'm staying with Lululemon. I'm staying with the brand recognition that these companies offer. Yes, Foot Locker in prior years, given the correlation and an exposure, as you identified, to Nike, that seemed to be an optimal trade. But the footprint, the physical footprint of these stores seems to be the problem for them moving forward. So why do I have to incur that type of expense management risk on my balance sheet when I could just go out and own the reason behind wanting to own Foot Locker, which is Nike itself, own the digital transformation that they're experiencing and the dramatic growth that's concurrent with it.
Yeah.
I see no reason to get out of Nike. I think this stock is north of 150 very easily.
It's really it's a commentary on the pandemic, back to school, the casualty of back to school that didn't really happen in traditional ways, obviously, because of stay at home, where you take your kids to Foot Locker, they pick out a pair of kicks and they're all set. Now it's just, well, you go on Nike.com and you do it, and that's reflective of what Rahel was telling us. Let's work our way up through retail before we get to the restaurants. This Gap call is interesting. It's interesting because it's Matt Boss, okay? He's the #1 analyst in retail. He's the boss. The stock, though, is up 80% in 3 months, okay? 80% in 3 months. He upgrades it now to overweight. Just because he's #1 doesn't mean he eludes some of the criticism of a timing of perhaps of an upgrade. He raises the price target to 30 from 22. Kramer says it's an amazing move. Retail in general is working. It's odd, he says, but it's working. So what are you going to do? The question is this too late, Steve Weiss? Is this too late to upgrade shares of Gap after an 80% move in 3 months, or is the runway really that long?
I don't think the runway is that long. It's a momentum market, so the retail stocks can continue to perform because of the momentum. But I look at these names and I'm saying, is the future better for them or worse as we come out of the pandemic? And I think the future is going to be worse. So I don't think a lot of these stocks, including the Gap, should be trading at higher levels than they were before the pandemic.
Why worse?
Because particularly they're mall-based.
How could they? I know, but how could they be? How could it be worse?
I'm not buying it.
How could it be worse than during the pandemic? I mean, if people are going to once again, maybe people fall in love with going to the mall again.
Right. Well, not worse than during the pandemic. I think it'll be worse for them after, before what it was going into the pandemic. Pandemic, let's take that off the table. More people are going online. They've got more options in terms of fashion because now they're online. They're getting educated about all the retailers. I do think traffic will come back to the malls. I don't think it'll come back in the same way. So, and Gap is, let's face it, it's generic clothing. I just can't get there on Gap.
It's really the great unknown, Liz, as to all of the naysayers and the negative commentary about the mall space, you know, pre-COVID, you have the obvious impact of the pandemic on retailing in general. But on the other side of it, I just wonder if there's going to be this renewal about going to places where you used to just not go in great numbers anymore, like the mall, because you would just go on whatever.com and buy whatever you wanted, but now you want to go out. You want to get out and be normal.
Yeah, I do think that once things start to get back to normal, there's going to be this pent-up kind of flurry of activity from consumers. So we might see a nice burst from that off of the lows. But a couple weeks ago, I was on the show. I used retail as my final trade because when we got big vaccine news, everybody flooded into consumer services, which makes sense because those are the businesses that we haven't really been able to visit. But retail got hurt on the other side of it. And I don't think that that was necessarily warranted. I do think that there's going to be, and I keep talking about this, we can start shopping on our feet instead of online. And there's going to be winners and losers. But the stores or the companies that can make that transition and have strength in revenue on both sides of it, both online and in person, are going to be big winners. And that is some of these names.
Jimmy, wrap up this segment for me by addressing these restaurant calls. Right? I'm not talking about quick serve like McDonald's or Chipotle, which Joe used to be in, and McDonald's, which Degas owns. I'm talking Darden to outperform, Texas Roadhouse to outperform. Best-in-class operators that can capitalize on an environment that is likely to include normalizing consumer traffic patterns and reduced competition over the next 12 to 24 months. That's the reality of what we find ourselves. Fewer players in the space because of the pandemic, but a more normalizing environment that boosts consumer traffic patterns.
I think it's a totally valid call. The key word's 12 to 24 months. Now, if you're looking to make some sort of vaccine news related trade on this, you got to understand the market is very anticipatory. We've already got 3 vaccines in the market already. So this isn't something short term. But if you want to look at this going out over the next 12 to 24 months, yes, I think you'll make money. But the short term pop is already in.
Yeah. Oh, yeah. Oh, look at that. Right. 320% off the low of the year. I think that was for Darden, which was at the top there. Just astounding gains back for those stocks.